The US dollar staged a critical rebound in the latest week after the FOMC rate decision was seen as not so dovish. And this week we have the Fed's preferred measurement of inflation, core PCE. How is the dollar going to react, guys? Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. So the dollar did close in the green this week after some selling pressure. And I did say last week how we formed this potential morning star, which has been validated with that closure above in this latest week. So there is room for this to continue to push to the upside. Now, in terms of the support, it comes after last week we had the FOMC rate decision and they weren't as dovish. Powell basically just said to the markets, look, we're in no rush to cut rates right now. And the key reason in the day is inflation. Inflation on an annualized level, I said this last week, remains well above the Fed's preferred area, which is around 2%. Okay, so there's still some work to be done in terms of inflation coming down. Plus, the economy, yes, has cooled, but not massively to warrant them cutting rates or be in a rush right now while they're on their goal of bringing down inflation. And two, obviously, there's a lot of uncertainty still with Trump's tariffs and the effects and the implications on the economy as to how inflationary those will be. So the FOMC right now are remaining cautious and they're holding. And you have to remember, these guys are not as dovish as everybody else. Everybody else has been cutting quite consistently, generally speaking, in terms of other major central banks. These guys have been on pause for a little while, and we expect that to remain the case. Now, that has given the dollar room to push to the upside now. Bounce at this psychological mid 103 region, and eyes are now on this sort of 105.50 towards 106. Now we're going to be keeping an eye on some data. Obviously with the Dixie, Euro makes up over 50% weighting. So these PMIs are key from Europe, which we'll talk about in a moment after this. But manufacturing and services PMIs due out from the United States. You can see they're still expected in growth territory. Remember, above 50 is growth, below is contraction. Numbers are expected to be healthy. We're more sort of focused on the services because US is largely a services-based economy as opposed to manufacturing. Services contributes more to GDP. Weekly unemployment claims, which remain steady. Okay, which, you know, the signs are that it's still tight. I know we saw the labor market softening at the last NFP report, but the labor market's still generally tight. And of course, Fed's preferred measurement of inflation due out at expected at 0.3%, which is still sticky. As we know, we saw the last CPI reading was sticky in the United States, and I expect this to remain the case as well with the core PCE. So I think there is room for the dollar to continue to push to the upside this week. Obviously, after this technical pullback that we had, the selling of the Trump trade, the uncertainty around the US economy, but markets are like, okay, maybe that's enough selling now. Dips to be potentially bought as long as it's supported with the fundamentals this week. The euro, vulnerabilities here for the euro versus the dollar. Why? Well, remember how we had all that pumping to the upside in the anticipation of that German stimulus? Okay, over 500 billion euros package to boost out the economy. Obviously, that was buying on anticipation, and now we're selling on the facts, so some profit taking coming into gear. And obviously, with that dollar staging a rebound. Now, we run into heavy supply at this psychological 109 area, 109.50. Okay, we formed a morning star validated by that closure below this week, and now look subject to some further selling. On the daily, you can see, obviously, we're trying to grind down this 108 zone. I'll be looking for something potentially like this, breakout retest drop down towards sort of 107. You know, we've seen it in the past here, you know, where the next major zone is. You can see it on a run up in towards 107. So that will be the target area, in my opinion, this week. Again, not financial advice, just what I believe is going to happen. Okay, PMIs are obviously in focus. We know these have been firmly in contractionary territory for a while. And I don't expect any major upside surprises there. Still looking for this to reinforce the narrative that we've been speaking about for weeks, months actually, where we've got stagflation, low growth in Eurozone, high inflation. So I would like to see these numbers. I'll be very surprised if these numbers come out higher or stronger. So that's my view for euro versus the dollar this week. And obviously to be harmed by the stronger dollar potentially, as long as data supports it. GBP. Now, we do have a number of risk events for the UK and obviously going to expose GBP this week. Now, when you look at GBP versus the dollar, this has held some ground, okay, versus the dollar in comparison to some of the peers. Why? Well, last week we had the Bank of England rate decision and it wasn't as dovish as what markets were expecting in terms of the vote, okay? Only one person calling for a cut. Markets were expecting two dissenters, two people to call for a cut. However, just one. And one of the key things as well is inflation remains sticky in the UK. This is why these guys are not rushing to cut rates. They're in pause right now, which is supportive of the pound. But this week, a few key things to note, guys. Obviously, we've got the PMIs, okay, from the UK. Services is the big one. That's what makes up over 70% of UK's GDP. So keep an eye on that. And obviously the manufacturing with that. UK CPI expected to remain sticky, just to cool down to 2.9 from 3%. Likely to remain sticky. Obviously, if it does, it's probably supportive of GP strength, because the Bank of England, it will just put the Bank of England further away from cutting rates anytime soon. Keep an eye on the UK annual budget release, which markets would like to see it as it being disinflationary. So the government cutting back on some spending. At the moment, then policies are seen as a little bit inflationary, which is not helped, obviously, UK prices of goods and services. So depending on if it's viewed by the markets as disinflationary, or if it's still not disinflationary enough, that will obviously dictate where GP goes. If it's seen as not so disinflationary, then of course it will likely potentially support the pound, because markets will be pushing back further rate cut bets from the Bank of England. And we've got UK retail sales expected a bit of a contraction here now, of minus 0.3%. I'm not surprised, because the Bank of England warned us before at various decisions. They've warned us that growth is going to be low in the UK, but prices are going to be high. So as an effect of low growth, which is taking a bit of a hit, obviously consumers feeling that, and then obviously prices remain sticky, maybe this is going to hit retailers and hit consumer spending, because where prices are so high, but people trying to be conscious of that, and growth economy slowing down, people cutting down spending, and those retail sales expected a contraction of minus 0.3%. So let's see. Obviously, that's quite a low number. So there is obviously room for potential surprise to the upside. But given how things are here, we could see GBP supported, okay, holding some ground. When we look technically, obviously, we ran into a heavy supply area here at 130. Bit of a flat candlestick there. We could view it as a reversal doji. It could go either way. But right now on the daily, it does look exposed to at least a drop down to sort of 28.50 as the next major zone. See how the price deals there. It could be a case breakout, retest and drop. It all depends on this data. But otherwise, if that holds ground and the data is supportive of the pound, we could be heading back to challenge those highs of last week up at 130. All right, so keep an eye on that. In the past, when we've sort of been between these zones, we faced rejection, as you can see, come up to 130, big rejection, come all the way down. Here, obviously, you can see zone to zone. These are the next key areas, 28.50, and then also 28 towards sort of 27.50. So keep an eye, obviously, on this data. A lot of key UK data there. Some volatility also expected for the Australian dollar AUD. So we have key CPI data, and this is important really, because inflation being sticky is one of the reasons why the RBA at the last decision cut rates, but hawkishly. They're like, look, we're not committing to further cuts until inflation comes down, because the labor market has been solid as well. It's been tight in terms of the labor market. It's been healthy, which is one of the reasons, which, remember that if we've got a good labor market, people obviously in the workforce, spending, stimulating the economy. Now, look at last week. We had lower employment change, contraction there, 52.8K, and negative, previous revised lower. All right, unemployment rate remains steady at 4.1%. And this is one of the RBA's concerns, where at the time, labor market was good, but which is why inflation was remaining sticky. So now we're seeing this cooling. Perhaps we could see these figures this week, CPI cooling. All right, so keep an eye locked in on that on Wednesday. When we look at AUD, we're moving within this rising channel. At some point, I do see this as vulnerable, especially with the tariffs, especially with Chinese slowdown. I'd like to see this breaking out of this channel and going bam, 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 and bam, 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 further to the downside, and just going to feel this wick down here, these lows. Okay, which is during the pandemic. Obviously, keep an eye on this data. It's very much dependent. Not to say that we're going to get the breakout this week, but we have room to potentially, especially if that dollar recovery picks up some pace, this could very well break out, retest 6250, drop, work zone to zone to those key areas, and then just play out to the downside there. So keep an eye on that Aussie CPI. And finally, the Canadian dollar. We do have key GDP data. Now, this is relevant right now because obviously CAD, the Canadian economy, is caught up within all this tariff saga. We know the Canadian economy has been slowing down. So keep an eye on these GDP figures. Now, last week, actually, we did see prices of goods and services remaining sticky. Look at that across the board. Inflation remains sticky. And again, this is a stagflation situation with Canada, because look at how low growth is. So it's not in the best of places right now. Seeing more misses on GDP for a while within recent readings. And, I wouldn't be surprised if we do continue to see lower growth in Canada. When we look at dollar CAD, specifically dollar CAD, it's caught in a really mundane range right now, very tight, as you can see. Working our way, we're capped to the upside at the moment around sort of 45, 44.50 up here. Okay, and capped to the downside down around here, really. These are both little sort of moments of breaking out of the range, but overall we're just caught. So I would just be, if you're a range trader, obviously this suits you, but otherwise look for opportunities outside of dollar versus the CAD. Look at maybe GP CAD, look at Euro CAD, so on and so forth. But right now, this is just caught up in a range, and I wouldn't be interested until we break out of this range. All right. So once again, guys, another week, field of economic events, and with Trump president, I'm sure we've got a lot more volatility to come. Have an amazing and blessed one. I'll catch you on the next video.